The weak stock market is, in fact, positive for gold now. In fact, you go overlay the chart of gold and the S&P, and they're exact opposites. So as the S&P rallied up off that March low, gold sold off its March high.
We wanted to discuss the precious metal markets first and foremost. In your weekly report, you were mentioning how really in the last 4 weeks, ever since that rally, we've seen that pullback. And then for the last 4 weeks, we've seen consolidation in gold. And it's been very oddly quiet and even possibly suppressed, you were mentioning. So can you expand on this?
Well, we're not big on the conspiracy theory stuff about the controlling efforts to control gold. But we know throughout history there have been times that governments around the world, the U.S. and like the IMF, for example, dumped tons of gold back in the late 1970s into that 1980 bull market. And initially in the bull market, when they hit it with 50 tons of gold, 200, whatever, and it would sell it at prices lower than the market even, it would knock gold down a bit. But after a while, those auctions didn't have any effect at all. In fact, the market just went right through them. So there's a point at which even if a market is being trying to be capped by somebody or some entity, for whatever reason, usually government policy, it doesn't work in the long run if reality says no. Reality will overcome their selling pressures. Central banks are not omnipotent. We know that. At least we should know that. In fact, they create the problems that they later try to cure. So anyway, but the action in gold, we ran up to on March the 8th. There was the high close in gold. It got up above the summer high of 2020, which was $2,070. Okay, we got to 2,078 on March the 8th, closed slightly off the high, and then we dropped hard for about 5 days. Traded under 1,900, so meaning you had a $170, $80 drop real quick, and then it stopped. Okay. Now, that was coincident, by the way, with an inverse situation in the S&P 500. It made its low close in March on March the 8th. So we've been making the point to especially gold investors and gold mining investors who tend to be nervous about a weak stock market. The weak stock market is, in fact, positive for gold now. In fact, you go overlay the chart of gold and the S&P, and they're exact opposites. So as the S&P rallied up off that March low, gold sold off its March high. But then gold went into a tight-fisted congestion zone with a couple ticks below 1,900, never closed below it, and a range in price for 4 weeks between about 1,950, 60 on the upside and around 1,900 on the downside. Generally, most of the highs were around 1940. So it was extremely narrow, quiet little range. During that same time, the S&P was cresting, by the way. Now, the S&P is rolling back over now, if you'll notice. So gold is shot back up today, got up to 1970, I believe. I think it's mid-1950s right now. But the behavior of that 4 weeks was highly unusual. We went from extreme volatility to extreme quiet, like a light switch had been hit. Well, we pointed out to our subscribers in our weekend reports, we put out a report about every day, but the weekend report's generally long, that yes, it might have been capped by somebody or some institution trying to keep gold suppressed. But if you look at the lows, somebody was bidding because the lows were equally tight and equally well bid for. So it was an arm wrestling match. So, we can look at the attempt to cap it, but there was also a floor under it. And I'll bet that wasn't government buying it. I bet it was investors. Now, another thing happened in the last 4 weeks, which is quite interesting. The gold miners. During a corrective process, like we've had from summer of 2070 high through late last year, the miners suffered more on the downside than did gold. In fact, gold made its low for the entire correction in March of 2021. Never took it out again. Whereas the miners kept bleeding down a little bit while gold was attempting to firm. We noticed about 3 or 4 weeks ago that the relative performance had shifted. We ran our spread charts between, let's say, GDX and gold, or the XAU index and gold, such that it said, favor the miners now. Well, sure enough, if you look at a gold chart for the last 5 weeks, go back to that March high 6 weeks ago. You dropped down and went into a range, and you didn't go back to that high. The gold miners went back to that high. In fact, they made a higher high today. So while the gold miners pull back a minor bit from that early March high, they've taken it out since then. So miners are definitely stronger than gold, which indicates to us not just that there's individual buyers of the miners, but that there's asset managers buying gold miners, because generally large fund managers won't go in and buy gold futures or bullion. They'll buy them companies, and they'll tend to defer to the larger, what you might call the blue chip companies like Newmont, for example. And so that's why I think you've seen this shift favoring the miners. It's a good sign for the overall gold, silver, and mining market.
I think that makes sense as well, because, I mean, you mentioned that if we're seeing bullish action in the miners, then that might signal a future run in the whole sector in precious metals. That kind of makes sense, because it seems like people are anticipating higher gold prices, and therefore that's good for the miners. So are they kind of pricing that in already? Is that kind of what you're seeing?
I think that's what's going on. I think they're gaining back some of the lost performance that they had for the last year and a half. They gained it back very quickly, by the way. And I think that, well, for instance, look at the XAU index, which is the oldest gold mining and silver mining index that's been around. It's not an ETF, it's an index. It's been around since the 1970s. It's back to the August highs of 2020. It's just sitting there, right at those highs. It didn't back off recently. It's glued to those highs. In fact, it may have already made a new high. So the miners are definitely acting better, not just over the last 4 or 5 weeks, but when you look at the last couple of years, they're back at the highs. Gold is still now 100 or so off that high because of the recent drop. But the tone in gold looks good. Silver, we still favor silver over gold on a spread basis, meaning we think it will, on a percentage basis, in the bull run to come, which is to say the remainder of the bull run we've already been in, will outperform gold on a percentage basis. We also think the miners will outperform gold on a percentage basis. So that's where we would put our emphasis.
What are some of the price points in silver that you're looking for silver to take out?
Silver turned up via it's what we call quarterly momentum, meaning we measure the price of silver in relation to its 3-quarter moving average. On a momentum chart, it broke out 5 or 6 weeks ago when it came up through low 24s. Okay, its initial shot took it over 27, and it pulled back down into the low 24s again and sat on that support, and now we're back in the low 25s. We've got some numbers above that are on a larger time scale. In fact, it's a 200-week momentum chart. Okay, it's like a 4-year average. It has a structure such that if you get back up anywhere in the high 26s again, it says, okay, I'm engaging as well. It looks very ripe to do so. I don't think resistance, which is pretty obvious on a price chart. When you look at a price chart, you'll see there's a zone from $28 to $30 where the high weekly closes were, either side of 28, and a couple high trades. This is back in 2020 and early 21. I don't think it's going to be an effort to get through that stuff. The issue is getting up to it. And I think once you get up to it, you're going to zap through it quickly. And I think the tone in silver will change dramatically. And so right now, if I put a new number on silver that would say, okay, we're not only positive now, basis quarterly momentum, but we're going to engage the 4-year average structure, which is already positive. It's a secondary buy structure. It's hard to explain. Anyway, you get in the upper 26s again. You don't even have to get back to that high we made in early March. You get upper 26s, underside of 27, you should be back to the highs very rapidly, back to that $30 range. And that should not be resistance. And I think once you clear that on the price chart basis, that's when you're going to have a lot of people who are on the sidelines say, oh, I better be in this. Because it's bleeding obvious when you look at the price chart. We go through that 30 level, it's a launch. But our numbers just below 27 right now should really engage it.
And will that need to be like a weekly close?
No, just touch it. Just get up there. Just trade up there. So that's one thing we're looking at. We also look at everything, and we look at any numbers we might have on the gold miners and so forth. But they're pretty much fully engaged now. What they did over the last 5-6 weeks in the gold miners says we're alive. We've come out of the process that we were in for the last year and a half. We're now back into the major primary trend. And I think it's very interesting that it's going on while the stock market's starting to roll over again. People need to pay attention to that.
when it comes to public acceptance of non-fiat currency, right now, I mean, the percentage of people's portfolios that is precious metals is so small right now. And it just seems like there's tremendous upside potential if we just see, it move from 0.5% to 1%, 2%, 3% of people's portfolio. That's tremendous upside for precious metals.
Absolutely. I mean, the gold and silver mining sector is a little teeny dot. If you have any movement at all, no wonder it's so strong, because if it gets chased by asset managers who want to move a couple percent out of the stock market into the gold and silver mining area, it'll goose that market up sharply. And that, I think, is what you're starting to see now, is very rapid rise. I mean, we were $28 on and change on GDX back in late last year, the end of last year. It's traded over 40 today. Okay, in a matter of 3 months or so. Boom. And most of that, a good chunk of that, occurred in the last 4 or 5 weeks. So yes, you're absolutely right. That's one reason we tend to like the miners, because we know fundamentally, though we don't assess them that way, we're technicians, that the mining group is extremely profitable by any normal metric and undervalued.